If you are an NRI, meaning a non-resident Indian, earning abroad and saving a decent chunk of your income, you have probably asked this question more than once. Should I invest my money in India? And if yes, how do I do it properly? Where do I start and what exactly are the risks involved? It's a fair question. You want your money to grow, but at the same time, you don't want to get into tax traps, compliance headaches, or make emotional investments that you may regret later. And the truth is, there is a lot of noise and not enough clarity out there. Every relative or a random blog post will give you a different opinion. And most of it isn't tailored for real NRIs like you and me. So in today's video, I'm giving you an ultimate step-by-step guide of how to invest in India as an NRI in 2025. This is not a surface level overview. It's a deep dive created with absolute clarity, practical logic and fully spoon-fed so that even if you have never invested before, you will still walk away knowing exactly what to do. Let's start with a basic question. Why even consider investing in India? See, it's easy to get lost in what West is doing. But India is not just your emotional home, it's an economic rocket ship. India's GDP is projected to grow at 6.5 to 7% over the next few years. And when you compare that to developed countries like the US, which is expected to grow at around 2%, or with the UK, which is struggling with 1 to 1.5%, India clearly stands out. But this isn't theoretical. If you had invested 10 lakhs in a Nifty 50 index funds 10 years ago and simply done nothing, you would be sitting at nearly 35 to 40 lakhs today. And that's without picking any individual stock. And you know what's even better? You understand India. You have lived there. You know which brands people trust. You know that people bank with HDFC, shop at D-Mart, and order food from Zomato, Swiggy. That local insight, foreigners don't have it. You do, and that's your edge. Now let's move to the core foundation. What accounts do you need as an NRI before you invest in India? You need to understand three important account types here. The NRI account, NRO account, and FCNR account. Don't worry, I'll explain all of this in very simple language. First, the NRI account. That stands for non-resident external account. This is a bank account in India that you fund using your foreign income, meaning money that you earn outside India. Money is held in Indian rupees, and the best part is any interest you earn here is completely tax-free in India. Plus, you can take that money out of India anytime. That's called repatriation. It's ideal for sending money home, investing in rupee assets, or even just parking funds short-term. Second, the NRO account. Non-resident ordinary. This is used to manage income that you earn within India. For example, rent from a property, dividends from Indian shares, or your pension. This account also holds Indian rupees. But unlike the NRE account, any interest earned here is taxable. Also, taking money back out of India from an NRO account is more restricted. You will need to fill out forms like 15CA or 15CB with the help of your CA. And you can only repatriate up to $1 million per financial year. Third is the FCNR account. That stands for foreign currency non-resident. This one is interesting. You deposit your money in foreign currency like USD, GBP or Euros into an Indian bank. It's usually done as a fixed deposit. Here the money stays in foreign currency. You earn interest and that is also tax-free in India. So that way you don't have to worry about any exchange rate losses. In my opinion, FCNR accounts are best for your capital protection. Now that your accounts are sorted, let's talk about exactly where to invest. Option 1, NRI fixed deposits. This one is really simple. You put your foreign earned income into a fixed deposit in your NRE account. Interest rates right now range anywhere between 6 to 7.5% depending on your bank. The returns are tax-free and repatriable. But here is the catch. If the Indian rupee depreciates, your actual return in dollar or pounds may drop to just 3 or 4%. So use this option only if your goal is capital safety, not aggressive growth. Option 2, FCNR fixed deposits. These are fixed deposits made in foreign currency. Interest rates here are a bit lower, around 3 to 4.5%, but there is zero exchange rate risk. You simply get your dollar or pounds back with interest. No conversion, no stress, nothing. Use this if you're ultra conservative and don't want any rupee exposure. Option 3, Indian mutual funds or ETFs. Now we are talking real investing. Mutual funds are professionally investment products where your money is pooled with others and invested into stocks, bonds or both. If you're a long-term investor, believe in India's growth story, in my opinion, this is the smartest way to grow your money. You don't need to pick individual stocks, just invest in funds. You can start with index funds. These track popular indices like Nifty 50 or Sensex. They have low fees and give you market matching returns. If you want a bit of more growth, you can try flexi-cap funds. They invest across large, mid-cap and small-cap companies. For slightly lower risk, hybrid funds are also good. They mix debt and equity. To invest in mutual funds, use your NRO or NRE accounts via platforms like Coinzerodha, Grow, ICICI Direct. Always use your NRE account if you plan to take that money out of India later. Now let's talk about taxation. This is really crucial, so listen closely. If you sell equity mutual funds within 1 year, any gains that you make on that are treated as short-term capital gains. As of recording this video, these are taxed at 20% plus applicable surcharge and cess. Short-term capital gains tax was increased from 15 to 20% in the July 2024 budget. And if you hold those units for over 1 year, those are considered long-term capital gains. The good news is that the first 1.5 lakhs of such gains that you make is exempt per financial year. For long-term gains that you make over 1.5 lakhs in a year, the current tax rate is 12.5%. I would just like to add here that if you're based in the US or Canada, be a little careful. Indian mutual funds may be treated as PFICs, passive foreign investment companies. That means you might have to pay tax in your home country every year, even on unrealized gains or profits you haven't withdrawn. It gets a bit messy. If that is your situation, skip Indian mutual funds and use Gift City platforms or US listed ETFs instead. Option 4 is direct stocks. Yes, as an NRI, you can invest directly in Indian shares. You will need to open a trading and demat account linked to your NRI or NRO accounts. Brokers like Zerodha, ICICI Direct and HDFC Securities offer NRI accounts. This option is best suited for people who want full control and most importantly know how to research companies. Tax rules around stock investing is same as mutual funds. Option 5 is PMS or Portfolio Management Services. This is for investors with 50 lakhs or more. So if you have 50 lakh or more capital to invest and you want to completely outsource all your investments to a SEBI registered professional who can manage your investments, this option is best suited for you. Basically, they create a personalized strategy just for you. It's active management, full reporting, but comes with usually high fees. Only use this option if you want someone else to do all the work while you get customized results. Option 6 is Gift City. This is Gujarat International Finance Tech City. It's India's global financial hub. You can invest in both Indian and global assets here using your foreign currency. The best part is there are zero Indian taxes, full repatriation, and it's compliant for US residents too. That means no PFIC issues. Platforms like Stockle, Vested, HDFC, IFSC, and Kuvera Global operate here. In my opinion, this is the cleanest way to invest as an NRI, especially if you live in the US, UK, or Canada. Option 7, real estate. Yes, as an NRI, you can buy both residential and commercial properties in India, but not agriculture land. If you're buying a 1 crore apartment in Mumbai, expect to earn not more than 20 to 25,000 in monthly rent. That is just 2.5% rental yield. Meanwhile, your EMI may be 80 to 90,000 rupees. Also, when you sell a property as an NRI, the buyer of that property has to deduct 20 to 30% tax at source, not on profit, on the full sale value. Of course, you can claim a refund on your ITR, but that takes time. Also, if you want to later repatriate that money abroad, you will need CS certificates and RBI approval beyond 1 million per year. So unless you're buying that property for self-use or you want to give it to your family, then real estate could be a lifestyle purchase, not an investment. Having said that, real estate has potential, especially if you find a hot spot in a tier 2 or tier 3 cities, which is expected to do very well in the coming years. So if you're someone who have local knowledge, have good knowledge or visibility on any upcoming hotspot locations in your area, then real estate can be a very lucrative investment as well, especially on lands and commercial properties. Now let's talk about common mistakes NRIs must avoid. Mistake number 1, confusing between NRI and NRO accounts. NRI is tax-free and repatriable, while NRO is taxable and has repatriation limits. Mistake number 2, ignoring your resident country's tax rules. Just because something is tax-free in India doesn't mean it is tax-free in the US or UK as well. Mistake number 3, not filing Indian tax returns. If you earn more than 2.5 lakhs per year in India, you will need to file an ITR even as an NRI. Mistake number 4, buying property emotionally. Always do the math. Ask what is the rental yield, what's the monthly EMI, what are the exit taxes. Please don't buy blindly. So what you should do now? Follow this 4-step framework. Step 1, clarify your return plan. Are you ever moving back to India or are you planning to retire abroad? Step 2, choose the right mix of accounts. Use NRI for investments, NRO for local income, and FCNR for capital protection. Step 3, match product to goals. For short-term goals, use FCNR or NRI FDs. For 3 to 5 year goals, you can use hybrid funds. And for long-term wealth, you can consider using mutual funds, stocks, Gift City or PMS. And step number 4, always stay compliant. File your taxes. Report your accounts abroad. Use a qualified cross-border tax expert if needed. So to wrap this up, India is definitely one of the most exciting investment destinations in the world. But only if you understand the rules. You don't need to rush. You don't need to become an expert either. You just need the right guide. And that's what we do in this channel, NRIwhizzofficial. So I hope this video gave you some clarity. If you found this video useful, please like and do consider subscribing. And do share with your other NRI friends as well. So this is all I had to cover for this video. I'll see you soon in another interesting video. Till then, you take good care of yourself. This is me, Pratik, signing off from NRIwhizzofficial. Over and out.